A week ago, I was at a family office event where I learned more about what venture capitalists and private equity firms are ultimately looking for, experiencing, and think will happen with companies in the future. Now, the idea that companies are inefficient is simply to say that they are no longer really kind of 3 to 5, maybe 7 year investments. They're actually longer investments. And so ultimately, if you're in venture capital or private equity, realizing that it's actually going to take longer for you to get a return on your investment. And ultimately, your capital is tied up longer. So, what are some ways to mitigate and reduce this challenge? The first thing is to look at projected growth. With the companies that you have invested in, it's understanding what the marketplace is needing as well as what you are providing for it. Gone are the days of essentially you sending a check and having occasional meetings. It's really being more intertwined into the business on a more frequent basis because ultimately the industry as well as the world operates more frequently. So this is very important for you to stay more on the pulse, and you need to define what that looks like for your firm as well as for the company to ideally not micromanage, but rather empower and give resources for not only the best scale, but also the best margins. So that way, as you grow profitably and not just in terms of value. Now, another thing that private equity firms and venture capitalists are experiencing is that because things are tied up longer, there's actually more demand in the secondaries market. And so ultimately, if your risk tolerance and timeline portfolio has changed as the companies have really changed as well with, again, that longer timeline, it would then be looking more into, again, the secondaries market. You're not necessarily going to get as favorable of terms. There's going to be potentially more restrictions and other factors, but you would be able to have a quicker timeline and ultimately create relationships and benefit for those that are in the primary market who are looking to exit in some way. And again, could be an opportunity to get something on a discount because of that impatience and lack of liquidity that a primary investor was really ultimately initially aiming for and analyzed for, but has not yet received. Now, the third piece that has really come to be of what has happened and what seems to be a growing trend is the idea that a CFO and ultimately the financial team is really getting tired through these longer processes and ultimately might phase out, meaning that you're then going to have another financial professional like a CFO come in, kind of pick up the baton and continue on. That sort of changeover cost, timeline to find the right fit within the right sort of window is also another piece. And so, again, that's another thing that venture capitalist firms and private equity firms are really finding a challenge is not just finding the right people, but also having them stay in these companies long enough so that they can go through the full life cycle to actually give the returns and complete the return that the initial investment was expected on. Now, if you are just a common corporate employee, how does this really matter to you? Well, it's simply to say that as companies are changing because of the capital that they're having, there's ultimately more of a focus on profitability as well as resources, as I mentioned. So, what could you do in your day to day job to ultimately help that? If you're really focused on building your company, it would simply be as you are in the trenches of the company, being aware of what are the things that you could personally do and what you are personally seeing to share with the manager, with the executive team, and potentially even the funding organization, such that the things that you're seeing could actually be implemented and created and could be either more efficient, drive more revenue, increase profitability, increase market share, etc. So even though you may not think this could be applicable to you, it very much does ultimately, because if you're in, think of a Viking rowing boat and you have a team of 100 people rowing in a direction, if you notice that we should change something that ultimately, if that was given across the entire organization, that would ultimately change the direction, even by 1 degree, would give a vastly different outcome of where it is. So regardless of where you're at within the company or as an investor, it's important to recognize that the small things build. Now, if you are a venture capitalist or a private equity firm, how to go about this in transformational aspects is to, one, understand where you are on the cap table, also have strategic partnerships where if your equity is tied up longer than you expected, finding ways for the secondaries and other creative strategies to ultimately liquidate and have that capital as you might need it or potentially want it. As some companies go up and increase and then ultimately flatline in some aspect with market saturation or other conditions, it could be incredibly advantageous for you to continue to explore different exit strategies that are beyond just the traditional we invest, we hold on, and we sell. So, regardless of where you're at in the company, working on the company, or ultimately investing in the company, these are a lot of the trends that we're seeing from private equity and venture capitalist firms for how they're invested in companies and what the change is going to be, as well as going to continue to be as well.